Welcome to Bloomberg ETF IQ. I'm Matt Miller.
And I'm Alix in for Katie Greifeld. Thank you so much for having me.
It's a pleasure having you here. Let's get to the biggest stories in the more than $10 trillion global ETF industry. A Bitcoin ETF fake out. BlackRock pours some cold water on speculation. The SEC approved its ETF already. We'll dig into that drama.
Plus, volatility remains for Treasury yields. We're going to show you how traders are using TLT to position themselves despite some big drawdowns.
And Wall Street's fear gauge remains muted despite the surge that we've seen in yields. The boom in option selling ETFs possibly playing a part in this trend.
And Eric Balchunas from Bloomberg Intelligence is with us also. He's looking at the flows. Eric.
Alix, Matt, thank you very much for looking at the flows. It's mostly bullish, I would say. If you have the Qs at the top for 1 week, $3 billion, that's pretty good news. VTI and IVV and VU, that's sort of the Vanguard bid from advisors. That's at the top too. And then you have a little treasuries, right? BIL, that's short-term treasuries, and then TLT, which again has been this siren song in an attempt to buy duration, which hasn't worked all year pretty much. And then SUSA, for you ESG people, that's a good sign, right? ESG's having a rough year and a half, but SUSA taking in $600 million. Good news for ESG for a change. Let's look at the outflows. 1 week, a little bit of bad news. SPY on the top. I don't like to see it. And JNK. HYLB, by the way, that's high yield ETF that was the cheapest until Spider got cheaper. And I think someone moved all their money out of that into the Spider ETF because there is a cost-obsessed trend with ETFs. So we think that's what drove that. And then UNG, interesting, that natural gas ETF's been beaten up. People probably getting enough pain there moving out. Now let's pivot completely to what Matt talked about, which is the BlackRock ETF fake out. So there was news this morning from Cointelegraph that iShares was going to be approved by the SEC. It's not true. Both SEC and BlackRock denied it. But still, it's been part of this overall trend and push towards approval, which has moved up GBTC's discount from, again, all the way back here, we're talking 50%, up to negative 15%. This has been a proxy for the hopes of approval. And last Friday, the SEC said they're not going to appeal their loss to Grayscale, which, again, bumped it up a little more. So overall, these products are trading a lot on this news this morning. But Matt, Alix, it was a big fake out. A big 7% rip, came back down. And such is the life of the crypto trade publications.
Yeah, and a lot of people were hitting that headline. I saw, I think Benzinga had a report. They were citing Reuters that it was approved as well, and all proved to be untrue, which made today a little bit more exciting. Joining us now is James Seyffart of Bloomberg Intelligence and Kailey, Leinz, co-host of Bloomberg Crypto. That program airs tomorrow at 1 p.m., by the way, every Tuesday at 1 p.m. James, let's start off with you. How did this all happen? Did it roll from kind of the Grayscale people familiar story into this?
Yeah, I mean, it all happened literally from a tweet. And it ripped through everything. A bunch of sources started citing that it was approved, and then you saw a whole bunch of prominent crypto and financial people tweeting that it was approved. 15 minutes after the initial tweet went out, and even right around, Eric and I both sent out separate tweets saying that we thought this was fake news. And I basically spent 10+ minutes scouring SEC websites, everything I could find that would corroborate
10+
this.
minutes?
Don't
put yourself out, James.
Yeah. Well, I was watching the Bitcoin price rip up to $30,000, and I was like, I'm pretty sure this is fake. But I was like, I'm not going to tweet this is fake and say this is fake publicly unless I could have some sort of confirmation. Because there was a lot of news, right? The SEC had a deadline on Friday to file for an en banc, virtually an appeal in the Grayscale case. So we're going to get more information this week. So it wouldn't have been completely insane, but it was very unlikely in my view.
Okay, so you spent 10 minutes looking through the SEC filings. Kailey, you actually also looked through the SEC filings. When do you think we're actually going to get the news?
Well, that is the million-dollar question, Alix. Of course, the SEC has deferred making decisions on a multitude of these filings recently, so we'll see. They're facing some deadlines coming up. I believe ARC's deadline is in January, and yet it does seem like the pressure may be building. Given this deadline they just faced in Grayscale that James was talking about, they decided not to appeal that ruling, which of course found that they were arbitrary and capricious in denying Grayscale's attempt to convert GBTC into an ETF. So it feels like it might be kind of crunch time, but of course we know that Gary Gensler and the SEC more broadly has raised a lot of concern about market manipulation and fraud in the crypto markets. That really has been their reasoning why they haven't approved spot Bitcoin products in the past. We'll see if it changes going forward in the future, and frankly, what it may make a material difference at all to this market, given we have seen some whipsaws in Bitcoin. We certainly saw it this morning off of this news, so clearly there is still some anticipation and excitement there, but also given what we've seen with Ether Future ETF, which really hasn't brought with it much flow or excitement, it remains to be seen what actually approval might mean for the crypto markets.
Yeah, absolutely. I was going to say, Kailey, it really is just a $1 million question, maybe $2 million. James, what do we know about, judging from the price action as this fake news ripped through the market, can you tell us anything about what you expect for when we do get an approved ETF, flows and price?
Yeah, so Eric and I are very much on record that we think it's going to happen by that January deadline that Kailey mentioned. But also, we don't know what the next steps are for Grayscale. So we could see something happen before that if the SEC is forced to issue some sort of either deny for different reasons or approve before that January deadline. So we're very much kind of waiting to see what happens. This was kind of like a dry run for what's going to happen if these things actually do get approved. I mean, that was a rip. I mean, Eric said rip on live TV. It really was kind of very aggressive. So a lot of people obviously weren't expecting it. Maybe more people will be ready for it in case it does happen the way we expect it to. But it basically gave traders a playbook of what's going to happen if this approval does happen. Just signals that maybe the market isn't really ready for it. The other thing is we expect a bunch of these to go at the same time, the way the Ether Futures went, right? A whole bunch of Ether Futures ETFs went live on the same day. We think the same thing is going to happen with these spot Bitcoin ETFs. So what happens as far as flows, but we think it'll be significant. It's going to be a meaningful launch, and there's likely to be a lot of money at play here.
Kailey, I want to ask you about Gary Gensler, because you've interviewed him a couple times. You've gotten to talk to him offline and everything. And I want to just talk about his role in this, because he's always been the one stopping this. But after the loss to Grayscale, we're hearing that he's moving aside, letting the staff take over. They're very bullish on this. They're working with the issuers, we're hearing, and giving them comments. We've seen amended filings coming back in. And we think this is a good sign that they'll be approved by the January deadline. Are you hearing anything different than that?
Well, what Gary Gensler always says is he is just one of a 5-member commission. So ultimately, it doesn't just come down to the call of the chair. It's about the other commissioners as well, who could very well be taking steps that maybe Gary Gensler is not in this case. He has, though, consistently, without ever really changing, cited the fraud and manipulation concern. So it seems that he does still have that. I guess it's just a question as to whether or not the commission as a whole decides that maybe it is time to approve a spot product. He also is always really reluctant to comment on ongoing litigation. You don't always get a lot of news out of Gary Gensler. But maybe we could have some news from the SEC coming sooner rather than later, guys.
All right. James and Kailey, thanks so much for joining us. James Seyffart there of Bloomberg Intelligence. Kailey Leinz, of course, is my co-anchor on Bloomberg Crypto, which is Tuesdays at 1 p.m. And she also covers relentlessly Congress and Washington for us down in D.C. Definitely worth your watch. Now, joining our conversation on ETFs at large, John Davi, CEO and CIO, as well as founder at Astoria Advisors. John, I'm not going to ask you too much about crypto, but about, the real action in ETFs has been in rates, and it's been incredible to watch all year, especially since it's been a horrible year for treasuries again, not as bad as 22. But what do you make of all the flows that we've seen so far?
There's a comment like T-bill and chill, right? So you just buy T-bills, you're getting 5%, a little over 5% without taking any risk. So there's a push and pull between stocks and bonds and in general. So I was on your show in January, you asked me a very similar question. In January, I said, if you can get 4% and take no risk, that's pretty attractive. So here we are now, and it's 5.25 Fed funds. So it's even more attractive now. So I think that has repercussions for asset allocation and how if people want to play in dividends and all asset classes. So it's very impactful.
But, actually, I will ask you about crypto, because if you looked at what Eric was talking about in terms of a GBTC, that discount has been closing. Do you play that ahead of maybe an ETF launch? Do you want to get involved in the ETF to diversify, to different allocate?
So we wrote a report in 2018 about Bitcoin, right? Because we were getting questions about it, and Bitcoin didn't nearly have as much interest as it is now. It is still our most widely open and read report. So it said something to us. So a couple years ago, we were getting like questions, okay, how do we use it? So about a year ago, we started putting together like a crypto equity and crypto kind of model portfolio. And we did use BITO, things like Block, some of the crypto miners. So we'd rather use the spot Bitcoin ETF for those that want to play in that space. And what we always say is like, size it appropriately, have it as a satellite. I think Eric makes this point about the jalapeno effect. Like, don't put all your eggs in it, just put a little bit. So if it's used appropriately, but I wouldn't play GBTC now after that narrowing a discount. I mean, when it was, minus 40%, that was more interesting than now.
Speaking of tempting trades, which is like what long duration and TLT has been, in my opinion, international to me has tempted a lot of people. It had that nice run about 6 months ago, and it just seems like it has these head fakes every 3 or 4 years, and then the Qs just take back over like a locomotive that you can't stop. You do have some international ETFs in here, but you do hedge them, and the hedged version's obviously outperforming by a lot, like HEDJ. Do you still like this, and how do you balance that going to that value of international versus what always seems to work every time?
Yeah, so there's a saying like you own growth and then you rent value. So I think U.S. is generally like a growth market. International is more of like a value. So I do think that you should own both. From 2000 to 2010, the S&P was down 10%, NASDAQ was down 40%. So you just made a point that like things, like it doesn't always go up is the point, right? But in that 10-year period, and you tweeted this chart out, emerging markets were up 150%, right? So this idea that like the only growth in the U.S. is in those 7 FANG stocks is just not true, right? There's some really good companies overseas. You didn't mention DXJ, but DXJ is up 40% this year, right? So, our core is U.S. equities, whether it's things like, DGRW, Qual, SPGP, but then like some of our tactical tilts are like DXJ, HDJ. Those 2 particular ETFs that you've got stronger earnings momentum, you've got positive estimate revisions, much cheaper than the U.S., much further behind the inflation cycle, much further behind the interest rate cycle. So I think they're pretty attractive right now.
I want to get back to T-bill and chill. Do you start going out longer duration? I mean, you mentioned tempting trade. Everyone's been pulled into TLT, right? But it hasn't been a good trade. You've lost a lot of money on that now 2 years in a row. What do you think about getting longer?
So I was on your show in January. I said SPTL, and it was one of my 10 ETFs for 2023. So we still own it. Now, we're shorter duration than a benchmark. So if the AG is 7, we're at 6. But a year ago, if I were on the show, our duration was like 2 or 3. Right, so we've extended our duration a lot. What I would say is that if everyone believes a recession is going to happen, then yeah, maybe the trade doesn't work, right? So the only reason why it hasn't worked this year, TLT or SPTL, is that there has been no recession. But if you look historically, like in 2000, 2001, that recession, the 08 recession, 2020, I mean, TLT has had some monster years. And, it can act like, an equity-like return and gives you that inverse correlation. But I do think eventually it does work when you get into that recession.
Real quick before we go, alternative assets. Where do you go? Do you like them?
I do, and that's, with Bitcoin, it does fall in that bucket. I'd rather own, things like BTAL or GLDM. There's some inflation-linked assets, that I think are in the alternative bucket, things like GNR or, the fund that we sub-advise for PPI, where they're, low correlation to stocks and bonds, much cheaper valuation. In the case of BTAL, I mean, it's just purely inversely correlated with S&P. It's like negative 70% correlation. So I think now more than ever, you should have alternatives. And, Bitcoin is up for play, I think, and it should be.
John, great having you in the studio. Thanks so much for coming in. John Davi there of Astoria Advisors. Next up, we're going to dig further into yields and then gold. Speaking of plays that have performed poorly, this is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Alix Steele. All right, time now for ETF Brief. We highlight some stories and trends that caught our eyes. We were just talking about it, and the issue with TLT. It's the 20-plus year Treasury bond ETF. Now, to buy duration or not is an enormous issue for investors, and you can see that tension kind of playing out. So on the bottom panel, you have actual inflows into this ETF. That's about $18 billion so far this year. On the top panel, you have the actual performance. On paper, you would have lost something like $10 billion this year, but that tension really playing out. Now, if you do like duration, what do you do with the credit market? So check out the next chart. It shows the short interest for LQD and HYG. It's the investment grade and high yield credit ETFs. Now, overall, you're seeing net short interest coming in like $14 billion. And as the market kind of waits for something to break, that's one way that investors are actually playing it. Now, I want to end with gold here, A, because I like commodities, but also because it's actually kind of interesting. Actual gold this past week has been a safe haven, but the gold ETF, not so much. So this shows the total known ETF holdings in gold. So all the physically backed funds. It's at a 3-year low. We're looking at 86 million ounces. Does the gold price actually rally further from here unless you see some interest into these physically gold-backed ETFs? I don't know if that's a given, Matt. And it is curious as to that you're not seeing that inflow, that safe haven inflow into the ETFs, but then you look at the Treasury market, you're like, oh, well, it's 4.7%.
To me, it's interesting that the underlying commodity has continued to do so well or hold at these levels, right? It's over $1,900 a troy ounce. Even as inflation has come down so dramatically and you're getting 5% yields on 2s and 20s.
I would add, so the gold ETFs own a couple percent of all the gold. So it is a small amount. I think gold probably moves, would move the ETF. Also, the zero correlation. It always does what you think it isn't going to do, and that, I think, is the beauty of gold. It just does, it marches to the beat of its own drummer. It's not inverse or correlated to anything. It's zero.
But I would point out that the gold bulls are going to say that that percentage of ETFs, if that grows a little bit, that moves the price a lot because the above ground stock of gold is so tight.
It's definitely a huge factor.
All right.
And it has been. That's also why the Bitcoin ETF is so exciting to people, because it will be a factor.
Yep.
I like it. All right, still ahead. We'll look at more stuff. The boom in option selling strategies with Sylvia Jablonski of Defiance ETFs next. And check on the equity rally here. You can see it. QQQ just soaring. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller, along with Alix today.
And Eric Balchunas from Bloomberg Intelligence is back with us now for today's drill down, where we focus on one ETF, Eric.
Thank you, Alix. So today we have QQQY, which is a sort of take on the Qs. The NASDAQ 100, we're good there. And then here's where we have a lot of stuff to deal with. Enhanced Options Income ETF. Effectively, it holds the Qs. If you want to look at the holdings real quick, it holds the Qs, and then it also writes options. But it's not just any options, it's zero-dated options, which have been very popular recently. It's the first ETF that uses these options. But again, it's not trading them every day. It's really just writing those options to get income in order to buffer your downside and give you extra yield. Right now, since it's launched, it's yield 6% already. Let's look at the performance of it versus the Qs, and I'll show you that 6% yield and how handy that comes in a downturn. You can see here, here's this ETF. It's about flat. The real Qs is down 2%. But look at the yield. It's down 6% in price, but you throw the yield in there, the total return gets almost annihilated by that yield. So boomers love these sort of yield ETFs that write put options on the market or call options because they buffer the downside. So even though it sounds a little crazy, zero-dated options, Alix, this is actually something to appeal to conservative boomers.
Is he calling me a conservative boomer?
You're not there yet.
I'm not. No, I'm not. I'm not a conservative boomer, but maybe Matt is.
Not yet. No, I never will be, right? I missed the cutoff date. I'm 73.
Okay, good for you. That's awesome.
Let's talk about this. Eric, thank you very much for that setup, and Alix for the insult. Let's talk about this with Sylvia Jablonski. She is CEO and CIO at Defiance ETFs. I'm sure this wasn't aimed specifically at boomers, right? It's interesting, though, that you're using 0 days to expiry options. How much does that take the edge off? How good are they at hedging?
Yeah, so actually it's not catered to boomers, but they certainly like it because they like the income. But you actually have this, if you look this up on YouTube, you have very, very young people that are super psyched about 0 days to expiry options, and they're kind of whipping them around. So the audience is very broad. So In the case of these, you're using short-term puts that expire within 24 hours. So at the end of the day, we essentially enter into a put writing strategy to try to capture that volatility within a 24-hour period. The trade unwinds within 24 hours, and you get that income, and that's it. So there's no sort of hedge. You know, it's not like a typical put strategy. We're essentially holding cash and treasuries and selling at the money and slightly in the money puts to generate income.
Let me defend my boomer statement real quick. Okay. So we actually have a phrase, boomer candy. And I actually want to tag this in data for a certain ETFs that, here's what boomers, they made all this money in the market, and they want to participate, but they want to take a little downside off, and they're willing to give up upside. So even though zero-date options are in the name, and it sounds crazy, retail, FOMO, Robinhood, you're actually, you're giving up your upside to give a little downside protection via that yield. That's why we call it boomer candy. And you're not alone. JEPI is $30 billion, and there's been many copycats. So am I right in that respect?
You are so right, and it couldn't be more boring in the best possible way. You can run this in an IRA. To your point, what you're sacrificing is upside, right? So you get a little bit of upside. We're going to look for strike prices that are slightly above where the NASDAQ is or the S&P 500 is. But what you're doing is just looking to generate that income. So your ride will either be in line on the equity performance, perhaps a little bit less if it starts to, kind of rally to the upside. You'll do better in a downturn. So the worst day, NASDAQ was down 1.7%. We were down 1.4 because we captured that 0.3 of premium. And in a market that's kind of range bound, 1% up or down, kind of flat, you're getting 100% of that premium on a daily basis, which can be anywhere from 0 to 1%. And why this is a little more elegant than some of the other covered call strategies out there is because you get 25 or so bites at the apple each month. So you're not stuck with this covered call strategy where mid-month you're kind of stuck with your strike, right? Each day we reset and try to generate that income again.
Quickly, if you get like a 20% sell-off, like a proper sell-off, does this strategy still make sense?
It should be, in theory, depending on what the premium is that you've achieved, down less than the NASDAQ or the S&P 500 would be. But certainly the risk of the fund is similar to the risk of holding the equity or having the equity exposure. The income is your upside. So as Eric said, this is great for boomers because you're in the market, you're touching equities, you're dabbling with them, but you don't have any more risk than the equity itself, and you have the benefit of generating that 0 to 1% of premium on a daily basis. And the first div distribution on QQQY was annualized at 67.5%. On JEPY, JEPI, it was 55%. So that's, from selling in the money, at the money puts on a daily basis.
All right, Sylvia, great to have you in the studio. Thanks so much for joining us. Sylvia Jablonski there of Defiance ETFs talking up QQQY over JEPI. If you just can't get enough of ETFs, a reminder you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry. I think bi-weekly means once every
I still don't know.
No, bi-weekly is
I have to look it up.
Twice a week?
Yeah.
No. All right, anyway, that does it for ETF IQ. I'm Matt Miller with Alix Steele and Eric Balchunas. This is Bloomberg.